The auction in any market, it's pretty straightforward. There are two types of market participants. There's buyers and there's sellers. And the degree to which these buyers and sellers are motivated by current price or market behavior. And yeah, there's a lot of nuances to complicate things, but the fundamentally important factors are pretty straightforward. For example, a buyer might believe that silver is too cheap at a certain price and therefore place a bid at that price, hoping to take advantage of what they believe to be an overextension lower. As an aside, when I trade overextensions in price, I am playing a mean reversion type of trade setup. And a potential seller of silver might be holding a long position and decide that if the market breaks quickly lower, maybe due to a news release, then they must exit the trade. But what an individual market does is the sum of all its parts. It's the sum of everything that the buyers and the sellers do. Buyers and sellers can be poorly matched, with the majority viewing current pricing as too high or too low, or they can be well matched overall where buyers and sellers are equal. When there is a mismatch, there is an imbalance or a trend. When participants of each type are roughly equal in strength, there's a balance or a range. Markets move back and forth between imbalance and balance, and I want to focus on the balance part of that equation, what many of us would call a trading range. And what a balance shows you is that for whatever reason, buyers and sellers have become temporarily matched in strength. The market moves one way as buyers step in, and then back the other way as the sellers return it back down. In some cases, the majority of the activity happens somewhere near the center of the range, and the volume distribution resembles a bell curve. In other cases, there can be a skew to one side of the balance. But what it shows is low activity at the extremes of the range, indicating that these prices are not widely accepted. Balance can be in the form of trading ranges, for example, or even pennants if you consider classical chart patterns. The key is that the market is moving sideways, not in any sustained direction. And this can be seen on very long time frames down to very short time frames. The thing is, balances can form for a variety of different reasons and in a variety of different ways. They can form after a large directional move as the market rests. They can form before a highly anticipated announcement as participants are reluctant to commit in either direction. Think of the FOMC release. They can form if the market has priced in all currently available information. Now, quickly identifying when and why the market is starting to range can stop you from taking trades against the probable action and create a plan of how to trade when the market breaks and starts moving in a specific direction. And the key to understanding why balance is important is that to break balance, something must have changed. Due to the fact that both buyers and sellers are active and that one side will end up losing by the very nature of a balance, the market is building up steam for its next move. When a trending market has moved into balance, trend traders will still be buying as they hope the downward movement is merely a pullback. If the market breaks against them, they're going to have to exit. And there's also the trader who's going to play the range, hoping to buy the bottom and sell the top of each move. When the market breaks an extreme of the balance, they're going to have to exit as well. And there are generally three ways in which a market can break out of balance, but really only two mechanisms. Lack of follow-through. The first is if the balance loses tension and a move out of it fails to create a strong directional move. And it's important to note that a balance range can also extend without breaking. And this is often what happens when there's not an increase in trading activity when the price extremes are probed. We have tests of extremes. And this is where the market tests above or below its extremes and then either continues in that direction if it finds more of the same activity, or if it doesn't, opposite activity steps in with some confidence in the knowledge that the first break has failed to precipitate additional activity in that direction. Now, often it's going to be the second mechanisms, the test of extremes, by which the market breaks. And when it does, it's pretty reliable that a decent directional move will follow. As you can see here, the moves following the break of the balance can be substantial. And whether you specifically look for ways to trade a break from balance or you simply use the activity to reinforce your current strategy, identifying balance early on and then monitoring the market as it moves to imbalance can help you get on the right side of the market. See, sometimes simplest can be the best. And if you're not someone who trades breakouts or positions prior to breakouts, well, the move of the market can inform the trading strategy that you're going to use. As an example, this chart here shows a strong break, and those traders who use pullbacks as a means to enter are rewarded. We see a lazy break out of balance here, and this could cause a trader to use a lower time frame for trade setups. When markets are not having movements that are simple to understand, using a lower time frame can actually show you some strong trending action. In the end, breaks of balances are events that you can trade or use for information. Whatever suits your comfort level and your ideas about trading is probably the one that you should focus on.